class is on futures and options markets. Futures and options are derivatives. A derivative is a financial contract that's based on some underlying commodity or asset. If you've signed a lease for your apartment, that's a type of derivative, broadly defined. We'll be studying derivatives for minerals such as gold and copper, agricultural commodities such as orange juice, sugar, corn, financial instruments, exchange rates, the Dow Jones Industrial Index, et cetera, et cetera. I want to introduce you to one of my teaching assistants in the back, Janet Horsiger, is right there. And the tutor for the class is Christian Lovell. He's also in the back. The other TA is on his way back from Europe, and he'll be here next week. So what I'd like to do today is give you a brief introduction to what we'll cover this quarter, and then a brief introduction to the material. So I'm glad to see so many of you here. I hope that means you're actually interested in these markets. Personally, I think this is a very exciting area because we'll be discussing events as they unfold during the quarter. You've all taken economic theory, you've all taken statistics, econometrics. Well, here's a course where you can apply those tools. If you've studied economic theory and the theory of demand, you know what it means when we talk about an inelastic demand. That's a demand curve that's very steep, which means that the quantity demanded is not that responsive to the price. So if you talk about commodities, let's say the sugar market, if there's a shortfall in the sugar crop and the price goes up, we don't see much of a response in demand. Most sugar that we use is in manufactured food products. Of course, we put some sugar in our cappuccino, but a lot of sugar is in bakery products and other food products. Small share of the cost of production, not very responsive to demand. So if you look at a shock in the supply of sugar coming out of Brazil, a large sugar exporter, that should lead to a big price increase depending on that demand elasticity. So this is where your economic theory is going to come into play. If we're looking at the crude oil market, that's big news these days. The news being the price of crude is back at $40 a barrel. Some people don't like that, such as producers in the Middle East, or if you own an oil well in Oklahoma, you might not be happy with $40 oil. Personally, I think it's great. I fill up my car, I can actually fill it up before the pump kicks out at $100, right? I can now, every time I fill it up, I feel like a rich man because I have an extra $40. So, you know, let's go for dinner tonight, let's go get a pizza. So I like $40 oil. But think about the economic theory you've studied. How does that apply to this class? Well, in this course, we're going to be talking about the price of crude oil. We're going to be reading the Wall Street Journal. We're going to be looking at the market for crude oil for delivery in November of 2015. We're going to be looking at the market for crude oil for delivery in November of 2016. We're going to be looking at the price of crude oil for delivery of crude oil in November 2020. And we're going to look at the market in the North Sea. That's called Brent crude. And we're going to be looking at the market in the United States. And we call the U.S. crude oil market the WTI. Christians just arrived from Texas. WTI is West Texas Intermediate crude. So your economic theory is going to come to play here. When you look at the price of crude oil coming down, in the summer of 2014, it was over $100 a barrel. It's now $40 a barrel. That's a big drop. What happens when the price falls to supply? Okay, you've been taught in economics that we're going to move down the supply curve, right? So who's going to drop out first? Well, maybe the high-cost suppliers. Who's going to drop out last? The lower-cost suppliers. So we see a decline in the number of oil rigs in the United States with the price of oil coming down. So there's a supply response. To understand the supply response, we have to know about the market. We have to understand the technology. Is this fracking that's reducing production? Are they reducing supply in the Middle East? Well, no. Turns out that Saudi Arabia announced they're going to continue to go for market share. Doesn't really matter what the price is. So they're a low-cost supplier. So these are things that are important to understand the price dynamics. And in this class, we're going to do paper trading. You'll each have an account online. It's called StockTrack. Has anyone used StockTrack in other courses? I know they use it in some of the finance courses. No? Nobody? All right. Well, let me just tell you one thing. It's always discouraging to me to talk to a student at the time of the midterm and they haven't yet started trading StockTrack. That means they're not going to do very well on the midterm. This is a great opportunity to learn how these markets work. StockTrack is worth, what is it, 5% of the grade? But you know what? It's actually worth a lot more than that. That percentage doesn't reflect the value of this assignment. You sign up for StockTrack, and this week you should start thinking of which markets am I interested in. Okay. Sylvia, what markets did you trade last year? Which markets are you interested in? Crude oil, gold, and currencies. The euro? Okay. There's three. That's good. That's a good plan to have three. And you know what? Those are related. There's a relationship between the price of crude oil and foreign currencies because crude oil, like most global commodities, is traded in US dollars. So if a foreign country's currency depreciates in value, if you've been reading the newspapers this summer, the US dollar is very strong today. The euro is weak. It's a good time to visit Europe. I think that's why Maxime's not coming back. It's so cheap over there, right? But if they're buying oil, they're paying more because their currency is lower. So start thinking about what markets you want to become an expert in. And I'll give you an opportunity to display that expertise in either one of the midterms or the final exam. And take StockTrack seriously. That's one piece of advice. It's the best way to understand the fundamentals of these markets. There's no better way than trading them. And then at the end of the quarter, there's a trading contest sponsored by the Chicago Mercantile Exchange. That's in January, isn't it, Sylvia? Yeah. Sylvia traded it last year. It's called the CME Challenge. I'm allowed to sponsor, I think, 6 teams or something from the class. You compete against teams from around the world. And we've never quite made it to the semifinals yet, but last year we were close. Was that your team? I don't know. One of the teams was close last year. Anyway, it's an opportunity to trade on the real platform. StockTrack, is over the internet. The prices are There's a bit of a lag in the prices. It's not exactly real time. But if you get excited about this and you sign up for a team at the end of the quarter, the trading actually starts in January, I think. But I can meet with you, but I'm not supposed to give you trading secrets. Not that I have any. But you get to trade on the global electronic platform that real live traders use at the CME. So that's another benefit of getting involved in StockTrack. Okay. Does everybody have a copy of the syllabus? If not, raise your hand, we'll get you one. All right. You do not? Let me just tell you what's in store. So, second piece of advice is, I know this is early in the morning, but those of you who come to lecture are going to do much better on the exams. Last year, I had a lot of students who were disappointed in their grade. They came to lecture, maybe once or twice at the beginning, and I'd see them when we had a quiz, and I'd never see them. And they didn't do very well. There's a high correlation between grade and attending lecture. Because I try to draw out what's in the book, what's in the Wall Street Journal, and we go over it in class, and then you'll cover it again in discussion section. If you choose not to come to class, you're probably not going to do that well. That's just another piece of advice. The material, you're going to sit there for a few weeks, the first few weeks, and think, he's going awfully slow. Can't he speed up? Do you have an extra one, Christian? You do? Okay. I don't think she got one. Well, I'm going to talk about it. Yeah, okay. So you're going to think, oh, he's kind of going slow. Can't he speed up? The material, you're going to sit there and you're going to think it sounds pretty easy. I understand this. But then when it comes to the first midterm, you'll find that it's actually more complicated than what it might sound like. This material is going to be new to most of you. I know most of you haven't really been exposed to the economics of these markets. But I guarantee if you stick with me and you come to class and you go to discussion, you pay attention at the end of the quarter, you're going to be pretty well informed about a very important financial institution. And it's going to serve you well in the real world. You're going to understand how these derivative markets work. Some students tell me after they've taken my class 5 years later, the biggest impact I had on their lives is I got them reading the Wall Street Journal. So they read that all the time. That's not such a bad thing. I'm old-fashioned. I still like to read newspapers. You can read it online if you like. Rules of the class, please try to come on time. Don't disrupt everybody by coming late. Please pay attention. When I'm talking to you, I expect you to be listening to me and not talking to your neighbor or looking on the internet. If you're reading the Wall Street Journal, I'll leave you alone. But if it's something else you're doing that's distracting you, I'll stop and ask you to pay attention. Okay, let's look at the course outline. So, there is a textbook. Called Futures and Options Markets and Introduction. This beautiful cover. So this is a book that I have written because I love this material. I love teaching this class. It's written at an introductory level. I publish it through CreateSpace, Amazon, so you're not paying $150 for the book. Okay, you get it for $35 or something like that. Yeah, it's on Amazon too. But it's also in the bookstore. And we updated it this summer, so I mean, maybe you could get a used one for 20, but you might as well buy the new one for 35. Material in the book is required, so it's best to read ahead, and that's all required. And obviously, I'm not going through it page by page. In addition, there are a set of class notes available in the bookstore as well. And what they are, they're photocopies of my slides to make it easier for you. So you can listen. Later on, when we start talking about options, we've got some complicated graphs, and you have to draw those properly with the puts and the calls. So it's all here. And what most students like to do is just take notes on the side. So most students will bring this to class and take notes as they follow what I'm doing. The Smart Site page should be up and running. If you have trouble, let me know. Sometimes it's just a matter of switching the browser. Some browsers, for whatever. Smart Site's getting better, but sometimes it's not so smart. So just let us know if you're having issues with it, okay? On the Smart Site, there's a registration for the stock track, and Janet's going to go over that in discussion and show you how to trade, how to sell sugar or how to buy orange juice. There's a initial endowment, is it 150, Janet, this year? Yeah. $100,000, something like that. That's how much you now have. Hopefully by the end of the quarter, at least half of you will have more than that. That's my goal, okay? Some students will probably make $200,000-300,000 trading. And one fortunate student will get a grand prize, the last class. So there's something to keep in mind. The grading, as I said, stock track's worth 5%. All you have to do to get the 5% is trade like 20 trades or something, but that's not the point. If that's all you do, you're missing out, and it's going to cost you. I will have 2 quizzes in class, and I'll take the best score out of 1. The purpose of the quiz is to give you a preview of the midterm. So usually the quizzes are about a week before each midterm. And if you do really well on the quiz, then you're in good shape. If you don't, then you got a week to sharpen your skills. The midterms are set. The dates are set. They're in the syllabus. Final exam date is set. I can't change those. I can't make up exams. I have like 140 students in this class. So if you feel that you have to go to a World Series game when we have the midterm, that's your choice. Right? I'm not going to make up a midterm so you can go to the World Series game. So look at those dates, and if you can't be here, then you'll have to take the class later. We have our office hours listed. You can always contact us through email. There's a chat room on Smart Site as well. And then I list on the second page the topics that we're going to cover. And as I said, we will start off slow. Some of it will seem repetitive. What I really like are questions from the class. That's a great way to learn. It helps me and it helps you. I can stand here and talk for an hour and a half, which is kind of boring for you guys. That's a long time to keep anyone's attention. It's a really long time. I'd rather teach a 50-minute class, but this is what they've given us. We're here together for an hour and a half twice a week. So help me out and ask questions. We're going to start just talking about the markets. I'll give you some examples. We'll look at how to read price charts. I'll talk about the history of where these markets originated, who trades them. There's two groups of traders, basically. In stock track, you're going to represent a group called speculators. Speculators are firms or individuals who trade in the futures and options markets to try and make a profit. Okay, there's nothing wrong with that. And when I say options, these are options written on the futures contract. Okay, we're not talking about the stock market here. This is not a class on the stock market. Yes, there are options on stocks. That's not what I'm talking about. I'm going to talk about the corn futures market in Chicago, where the price of corn is established for the entire globe through buying and selling, and the price changes every few seconds. And those are based on specific delivery months. I think in the case of corn, there's 6 different calendar months where physical delivery can take place. So if you're trading corn for June 2016, that represents the price of corn for delivery in June 2016. And that price is going to be set by supply and demand. Supply and demand reflect the trades that go in. If people think the price of corn is going up, they'll put in buy orders. If there's enough of them, the price will go up. If they think it's going down, they'll put in sell orders. So the speculators are buying and selling futures and options to try to make money. It's very risky. The vast majority of speculators in the real world end up losing money. They exit the market. We never see them again. There are professional traders who provide liquidity to the other side of the market. The other side of the market are the hedgers. The hedgers include firms or sometimes individuals who buy or sell the underlying commodity as part of their business. So it might be a farmer who's growing corn. It could be a beef producer who's buying corn and feeding it to the cattle. It could be a mining company in Australia that's extracting iron ore and sending it onto the world market. Their balance sheet varies with the price of iron ore, so they're exposed to the volatility in that market. And they might use the iron ore futures market to manage their price risk. And there could be some speculators in iron ore who think they know where the price is going, and they'll be in the market as well. So you have this mixture of hedgers and speculators who come together in the marketplace. The buy orders come in, the sell orders come in, they all get matched. For every buyer, there has to be a seller. Otherwise, there's no transactions, the same as any other market. You can try to sell all day, but if nobody wants to buy, there's no sale. So somebody comes in and says they'll buy it, then there's a transaction, the price is recorded. That's what happens in the futures market. These used to be conducted in trading pits where hundreds of traders would gather in Chicago. It's the Chicago Board of Trade or the Chicago Mercantile Exchange down the road. Or they gather in New York at the New York Mercantile Exchange. Or in London, the London Metal Exchange. Those days are pretty much gone, and it's not so exciting anymore because a lot of the trading is done electronically, where people are sitting at a computer screen sending their order in to the exchange, and it gets executed electronically. So we'll be going through the basics of the size of the contracts, where they're traded. Why are some contracts deliverable? In fact, if you buy a corn futures and you don't reverse it, you end up with some corn. Some contracts are not deliverable. You don't end up with the physical asset or commodity. It gets settled at the cash price. We'll learn about that. We'll learn about price spreads in the market. What determines the spread between December WTI crude oil, that's the US crude, December 2015 and December 2016? What determines that spread? We'll talk about that. We'll go through the commodity markets. And I mentioned a number of those. In class, I tend to use as examples a handful of commodities. There's 40, 50 different commodities traded in global futures markets. I'll tend to use examples, and those are the ones you'll see on the exams as well. We'll talk about financial markets. So that would be the currencies, the interest rate futures. There's a lot of trading in interest rate futures. Then the third topic is going to be analyzing and forecasting prices. We'll study alternative ways to analyze prices and alternative ways to forecast prices, which will be relevant to what you're doing in StockTrack. The fourth section of the class is called hedging. And that's really the heart of the course, because these markets, this institution, the futures market and the options based on the futures, serve some very fundamental economic roles. They're important economic institutions for a few key reasons. The first one I already mentioned. In Chicago, when you have traders sending in orders from around the world and the price moving daily, that market forms the price based on current information on supply and demand. If there's news that comes into the market that it looks as though the weather in northern China is going to turn bad and that's going to affect the corn crop, then the price of corn will be up in Chicago instantly, I guarantee it. It quickly transmits this information into the price. So that's price discovery, price formation, price dissemination. Farmers in South Africa can be riding on their tractor and look on their cell phone and see what the price of corn is in Chicago. Farmers in Australia can be in the outback, look on their cell phone and see what the price of wheat is in Chicago, because that determines the price that they will get locally. Obviously, there's exchange rate factors, there's transportation factors, but those markets are central for price discovery. Another key economic function has to do with hedging. As I mentioned, there are firms, the mining company in Australia, the corn farmer, airline companies. Airlines spend a lot of money on jet fuel. Their largest cost item is fuel. So their profits are driven extensively by fluctuations in the price of jet fuel. So if they can somehow manage that risk by using derivatives, they will do so. And many of them do, just like the mining company does, just like the farmer does. So those are hedgers. And you can think of their participation as a type of insurance. They're buying some insurance. They can't lock in a price. They can't guarantee the price of jet fuel. They can't guarantee the price of corn or iron ore. But they can reduce the volatility dramatically by hedging. So they take a position in the futures market. So the farmer, while the corn is out in the field, that individual is worried about a fall in the price of corn, right? So if the price of corn is $6 a bushel and the crop is still in the field, that individual is worried about the price dropping from 6 to 4. If it goes from 6 to 8, that's wonderful. But if it goes from 6 to 4, that's a problem. So what they can do is sell forward in the futures market until such time as the corn is harvested. And then they can reverse their futures contract and deliver the corn. Most futures contracts are not settled at delivery if it's a cash settlement contract, or they do not result in delivery. Most futures contracts do not result in delivery. The iron ore producer in Australia might be trading iron ore futures in Singapore, but they're not going to deliver that iron ore to Singapore, but they'll use that market as a temporary substitute for a sale into some other market. So that's what hedgers do. And then the final topic in the class is going to be options. So we'll go through a fundamental understanding of how futures contracts work, how they're regulated. I don't think I mentioned that. There's extensive regulation of these markets. And why are they regulated? Well, the US government and the governments in other countries believe these markets are essential and important economic institutions as long as they're competitive. So they regulate them to ensure that they are competitive. We'll go through that after we finish hedging, then we'll jump into options. So options have some different risk characteristics than futures. They provide an alternative to futures, whether you're a speculator or a hedger. You can use the futures market or you can use the options market. And we are going to learn about the options market as well. Okay, do you have any questions on that roadmap? All right. So here's a couple of quotes to hopefully pique your interest in what we're going to be doing for the next 10 weeks. So the first one is from a character named Ken Roberts. Okay, I don't know. Do any of you know what an Amway salesman is? You ever heard of that? What? What is it? Yeah, it's kind of household products and stuff like that. So Ken used to sell Amway products, and then he heard about futures markets, and then he started selling trading systems on futures, if you can believe it, and made a lot of money. And so if you look at his website, you know, his line is, "There's too much fun and profit for anyone with a dream not to grab a share." So the way to become happy in life and the way to become rich is to buy Ken's trading systems. And he will guarantee you a large return on your money. Okay? So we have characters like that in the industry. He's pretty much a technical trader who thinks he can predict futures prices from past prices. And then here's I would say a more modest person, perhaps. Mr. Johnson, who used to be chairman of the CFTC. The CFTC stands for the Commodity Futures Trading Commission. That's an agency in Washington, D.C., and it has the authority to regulate the futures industry. So it's separate from the securities industry, separate from the stock industry. So he was the former chairman of that committee. After he retired, he said, you know, I've never traded futures. It's too difficult, and I just don't have the skill for it. So here's a guy who's written, you know, large books on futures markets, but he's never traded them. Why is that? Well, I believe that the former commissioner thinks the markets are efficient. And what do I mean by that? I mean informationally efficient. I talked about the weather turning dry in northern China, and shortly thereafter, you'll see the price rise in Chicago. There was a study done a number of years ago looking at orange juice futures. And I'll talk about orange juice futures a bit later today. Those are traded on the ICE exchange, International Commodity Exchange. And it's frozen concentrated orange juice. So it's orange juice where they take the water out and it shrinks by a factor of 7 to 1. That's what's traded on the futures market. There's a number of stories around about people making money trading orange juice who had advanced information on the weather. There's a story about a group of airline pilots. So this was the days before the internet, who were flying from Los Angeles to Florida. They checked the weather, realized that there was going to be a frost that night, so they bought orange juice, and as they were flying across the country, they made a lot of money. Have any of you seen Trading Places? Yeah. Great movie. Should really watch it. And there's something in there about orange juice futures. Anyway, the whole point of my story is there was an economic study done looking at the informational efficiency of orange juice futures. Now, if you listen to Ken Roberts, he'll tell you if you spend $395 on his trading system, that he will make you rich trading orange juice futures. Mr. Phillips says, I think they're too risky. I can't beat the market, because he's likely read this study. So what these economists did was they looked at the orange juice futures market in the month of January, because if there's going to be a freeze in Florida, it's going to hit in January. So California produces oranges as well. The oranges we produce are for fresh consumption for the most part. The oranges for juice in the United States come from Florida, and we also import from Brazil. So what these economists did was they gathered this historical data on weather forecasts in January by NOAA, the National Oceanic and Atmospheric Administration. NOAA is the government agency that provides weather forecasts. So they asked an interesting question. They said, what's the best predictor, let's say on January 30th, in any given year, what's the best predictor of whether it's going to freeze tonight in Florida? The National Weather Service or the futures market? You think about it, you know, the National Weather Service, yeah, you could go to their web page and open it up, and it will forecast the temperature tonight. And if they're saying the temperature is going to be 28 degrees or 29 degrees, well, that's a frost, isn't it? Well, how does the futures market forecast the temperature? Well, there's no futures market for the temperature in Florida on January 30th. But what they looked at was the reaction of the price of orange juice the day before. And if the traders in the futures market thought there was going to be a freeze tonight, what's going to happen to the price of OJ? What happens if the trees freeze? Is that juice any good? No. So if there's a big frost, what's going to happen to the price of orange juice? It can either go up or go down. Which way is it going to go? Pardon? Yes, thank you. We've got to get this straight. It's going to go up. So they found that the best predictor of a frost in Florida in the month of January is a futures market. Forget about the National Weather Service. So what does that tell you? That tells you that the markets are informationally efficient. They are hard to beat because traders from all over the world are trading based on the information they have. And as a result, most small speculators have a hard time making money in the market. But we'll see how you folks all do. I'm sure some of you will do great. Okay. I've covered some of this already. We're going to do the institutional background. I'm going to tell you where these markets come from. I'm going to tell you how important they are in global commerce. We're going to talk about the economics of hedging. And I've already said that hedging is an activity to try to neutralize the effects of a price change. The mine in Australia is trying to neutralize the effect of a price change. They're not trying to profit from a price change. So the mining company is good at mining iron ore. They're not good at speculating on the price of iron ore. Southwest Airlines is good at providing air transportation. I actually like Southwest. I have a hard time liking most airlines, but I don't mind Southwest. They're very good at what they do. But you know what they're not good at? Forecasting the price of oil. That's not what they do. But it affects them big time. Therefore, they hedge in the derivatives market to try and minimize the effect of adverse price changes. Prices are now $40. That's pretty good if you're running an airline. But if they go back to 100 because all these rigs are shutting down, then your costs are going to skyrocket. So I hate to break the news to you, but I'm not here to do what Ken Roberts claims he can do and make you all rich. I'm not going to teach you how to make $1 million in the futures market. But I'm here to teach you about how these markets work, why we have them, how they function, and why they serve an important role in business decision making, e.g. Southwest Airlines, e.g. the mining company in Australia. But if you're looking for trading tips, this person who happens to be running for president, former Secretary of State, Hillary Clinton, actually made some very famous trades in cattle futures. Okay, so this is a true story. This goes back a few years when her and Bill were still in Arkansas. And she was trying to help Bill get elected to the White House. And they were short of money. They have lots of money now. In those days, they were short of money. And Hillary was an attorney, and she started trading commodities in 1978. And she turned $1,000 into $100,000 in 10 months, trading cattle futures. And along comes another economist. Okay, the economists are all over. Different guy than that looked at the orange juice market. But he knows about the cattle market. And he was surprised at this success. I said, how could you possibly take $1,000 and turn it into 100,000 in 10 months, given the stochastic behavior of cattle prices? You have to either be very, very brilliant or very, very lucky. And he calculated that the odds of doing that were 1 in 31 trillion. So maybe there was another explanation for those trading profits. And in fact, there was an investigation that got dropped, and it turns out that Hillary did make this money, and it did help Bill's campaign in those days. But it turns out her broker was running dual accounts. So on a given day, he would buy cattle in one account and sell cattle in another. And guess what? One of them's going to make money, and one's going to lose money, right? That's how futures markets work. When the price changes, there's a winner and a loser. We say that futures markets are a zero-sum game, because for every buyer, there has to be a seller. So if the price of cattle is going up, those who bought or went long are going to be making money. Those who sold short are going to be losing money. And he had a dual set accounts, and one of those accounts, after the fact, is going to be profitable. And then he could just shift those over to Hillary. Yeah. No, it was a broker. But he had another client who was basically a rich dude who wanted to give money to the Clintons, right? So that person took a loss, reported it to IRS. I had a bad year. I lost money trading cattle. And Hillary had a good year. Nobody knew the difference, right? You get it? Yeah. Okay. So what are we going to do? Well, I'm going to drill into you the economic rationale for these markets and how they work, and the benefits. And as I said, we're going to study the role of these markets as decision-making tools. Okay, I am going to try to show you a video, but before that, let me do something else. As I said, an hour and a half is a long time, and I've experimented with different things to break up the class, like tell jokes or talk about my family, but sometimes that's not all that successful. So maybe I'll just try to switch gears every once in a while. So that's the purpose here. There's sort of a fun set of futures markets called prediction markets. So we're going to be talking about futures markets on agricultural commodities, on metals, on soft commodities like coffee and orange juice. But actually, if you go back over 100 years, the United States used to have a set of prediction markets that were pretty active, and they sort of dissipated. And there's an attempt to bring these back, but it's running into some roadblocks with the Commodity Futures Trading Commission, because they sort of view this as gambling. And I'll talk about these later on in the class, but in fact, there is a useful role for prediction markets. And we have found that these markets are actually more accurate than polls. Okay, so we've got all these Gallup polls and different polls. Is Donald Trump going to be the next president? And they interview people on the street or phone them, and a lot of these people are uninformed. They're not going to vote anyway. So we have prediction markets where people actually put down real money. And later on, I'm going to be talking about one in Iowa. But here's a relatively new market. It replaced a market called InTrade, which is now out of business. It's called Predict It. And you can go in here and get an account. The most you can trade is $800. So it's not as though Donald Trump could influence this market unless all of his friends open an account. But you know what? Maybe it doesn't matter. The thing is, average person can go in here and you could trade different markets. And those markets range from political markets to, you know, how much revenue is a certain movie going to generate, you know, when's Vladimir Putin going to fall off a horse, you know, stuff like that, right? So there's one that I looked up yesterday on the Republican nomination. So who's going to get the Republican nomination? So according to the market yesterday, now it might have changed today, it's Marco Rubio, right? Anybody know him? He's from Florida, right? So according to this market, he's trading at 36 cents. Okay, so the way this works is you put your money in, so you could open an account, $800, and you could buy Rubio for 36 cents. You can buy Donald for 21, right? He's cheaper. Or you can sell Donald for 80. So if you buy Donald for 21 and he wins, then you get $1 back for every contract you've got, right? That's how it works. And you can also interpret this as a probability. So right now, Predict It says there's a 20% probability that Donald will get the nomination. And I think these numbers differ from what you see in the polls in the newspaper, right? I hear that, you know, he's leading and Carly is now up there. Well, it's not quite what we're seeing in Predict It. And personally, I'd put more weight on this market because the people who are buying Donald or selling Jeb are using their own money, right? And there's probably a bunch of people in DC who really think they know what's going on. They got the inside track, and they can trade it. So it's kind of a fun thing to look at, and I'll come back and talk about predictive markets later. Let's see if I can pull this off.
Manage their risk in order to import, export, or simply buy and sell their goods and services. Companies large and small.
That's not the one I want to show, sorry. Here we go. Bear with me.
Hi, I'm Rich Ilchishin. I'm here to teach you futures now. It may sound complicated, but futures trading is actually quite simple. A futures contract is an agreement to buy or sell an underlying asset at a future date. The quantity, terms of delivery, and price are specified ahead of time. And the underlying asset can almost be anything. Think about this. Gold, silver, wheat, oil, milk, it can also be financial instruments. Think of stocks or bonds. So think of futures as a contractual commitment. Unless you close a futures position before expiration, you could take delivery of the underlying asset. So it's very important to close that position before expiration. So remember, always close your position ahead of expiration. Now you might be new to futures, but they aren't new to the market. Actually, the earliest form of future contracts date way back to the Greeks. But the modern future market began in the 1800s.
I'm sorry, I don't think I started this from the beginning.
Hi, I'm Rich Ilchishin. I'm here to teach you futures now. It may sound complicated, but futures trading is actually quite simple.
Maybe I did.
A futures contract is an agreement to buy or sell an underlying asset at a future date. The quantity, terms of delivery, and price are specified ahead of time. And the underlying asset can almost be anything. Think about this. Gold, silver, wheat, oil, milk, it can also be financial instruments. Think of stocks or bonds. So think of futures as a contractual commitment. Unless you close a futures position before expiration, you could take delivery of the underlying asset. So it's very important to close that position before expiration. So remember, always close your position ahead of expiration. Now you might be new to futures, but they aren't new to the market. Actually, the earliest form of future contracts date way back to the Greeks. But the modern future market began in the 1800s in Chicago as a way to help farmers manage their crop risk. Today, all sorts of companies and individuals use future markets to help control costs. So here's how it works. Let's say airline XYZ is worried about the cost of oil going higher. It could go into the futures market and buy oil at a fixed cost at a later date. Let's say $80 for a barrel out a year. Now, no matter what oil does, this airline is insulated from rising costs. In other words, it took a variable cost, the price of oil, and turned it into a fixed cost at $80. Now this airline can confidently plan its expenses. Bottom line, this is what futures really do. They allow people and businesses to lock in prices and manage costs. For Futures Now, I'm Richard Chisholm.
Okay, let me show you one more. Yeah, I will.
When it's time to order a good steak, you might consider the price on the menu. But you're probably not thinking about why that is the cost. So, where do our beef prices come from? It all starts here, on the ranch, where a cattle producer faces a number of risks that impact his business and the price he receives for his livestock. Even when he plans well, market conditions outside of his control can unfavorably impact his profitability and success. The direction a herd's value takes rests squarely on a rancher's ability to offset a number of negative factors. And those factors can directly or indirectly impact livestock. Severe weather, rising feed costs, or the threat of disease can result in diminished health or less profitable herds. Similarly, events such as regular ranch upkeep and maintenance or escalating gas prices, which correlate to higher transportation costs, can have a more indirect but no less costly impact on a herd's value. And the ramifications can go well beyond the ranch, impacting the entire supply chain. Say the market is confronted with a catastrophic event, such as an extreme drought in the southern plains. Cattle ranchers are unable to successfully maintain their herds due to rising grain prices or feed costs. That, in turn, increases the price that feedlot operators must pay for cattle. Consequently, this impacts the price meat packers then pay feedlots for finished cattle and the price of meat that retailers sell to consumers. Seeing these things play out in the market, ranchers and farmers, as well as distributors, processors, investors, and others, can turn to exchanges to buy and sell futures contracts. That allows them to both manage risk and potentially profit by accepting risk. With so much at stake and so much volatility, the ranchers who use futures each season are the ones best positioned to protect the value of their business. And this value can be passed along to you. So that's a little insight into the risk cattle ranchers face every day. I'd love to talk some more, but I'm hungry.
Okay, that's just a little bit of additional information. The first video was really talking about hedging, and he talked about an airline company. And something I mentioned earlier is the price of fuel. So if we go back to 2008, this is the price of oil. Oil was at about $150 a barrel back in 2008. And you probably remember that we had a financial crisis in 2008, and the price did this. It dropped to 40 bucks in about a year's time. And I distinctly remember this time period in 2008 watching CNBC and listening to so-called experts in the oil market, people like T. Boone Pickens, who's a billionaire thanks to the oil industry. And he was predicting that oil, and he pronounces it differently than I do. He says oil, oil, oil's going to 200 and it's not coming back. Well, guess what? Dropped to 40. And then it sort of made its way back. Whoops, not quite that high. Here we go, $100. Made its way back to $100 in 2014. Okay, and now today it's back down at 40. So that first video was talking about an airline, XYZ, that is trying to manage this risk. So when oil was at $150, a lot of airlines were losing money, except those that may have locked in a lower price. Then when the price fell to $40, many airlines tried to lock in that price for 1 or 2 years forward, and those who did were fortunate because then the price went back to 100, and now it's come back down to 40. So the thing with hedging is it's an attempt to insure against an adverse price change, but like any form of insurance, you can't necessarily have your cake and eat it too, right? So if you buy insurance for your car and you don't get in a crash this year, well, you don't get your money back, right? So it's good you didn't crash your car, but you also had to pay that premium. So for the airlines who locked in a price at $100, thinking that T. Boone Pickens was right and it was going to $200 oil, and now it's 40, they're probably wishing they hadn't done so. But on the other hand, if it had gone to 200, they probably would have gone bankrupt. So those airlines are pretty sophisticated, and that's probably why they use options instead of futures to lock in that price. And the other day I saw a headline in the newspaper that said something like, cruise company revenue down due to hedging losses. Okay. Now, for me, that's an inaccurate headline. So if you have a cruise company that owns these large cruise ships, they also burn a lot of oil, right? And their profits are also driven by the price of oil. So if the price of oil is at 75 and they lock in that price for the next year, then it drops to 40. Would they have been better off not hedging? Yes. Do we call that a hedging loss? Well, no, because it was insurance. It's like you at the end of the year. Would you have been better off if you hadn't insured your car? I guess so. But would that be really wise? Probably not, right? Like if I went home and told my wife, we've been in this house for 20 years and every year we buy fire insurance and, we don't smoke, we don't even have fire. I don't think this house is going to burn down. Let's cancel our fire insurance, right? And it's a lot of money. So then next year, if we cancel the fire insurance, we'd have an extra, $1,200. Would that be a smart thing to do? Probably not. And I wouldn't call the fact that I've been paying fire insurance for the last 20 years a hedging loss, right? So when we talk about hedging, we have to be cognizant of the fact that business use of these derivative markets to try and minimize this volatility means that sometimes you're better off having not hedged in terms of the accounting, the way an accountant would look at it. You'd have more money, I'd have more money, a lot more money today than I do if I hadn't bought any car insurance or any house insurance for the last 20 years. Because I haven't had a car crash and my house has never burned down. So I would have been better off. But that's not the way to look at it, right? Because if my house did burn down, I'd be in big trouble. Okay, the other video, he was talking about how risk affects the rancher and how that also affects us in our daily lives. And there's a lot of truth to that. So if you talk to your friends and you tell them you're taking a course on futures markets, they might ask you, and it'd be a fair question, well, how does that affect you? What effect does the futures market have on you, unless you plan to make a career of this? Well, the truth is that these markets, and probably most of you here have never even heard of these markets before today. Some of you, even now, having sat here for over an hour, probably still have no idea what I'm talking about, right? Is there anybody here who has no idea what I'm talking about? There could be. I'll venture a guess. Okay, I'll put 30 cents on that. How does it influence our daily lives? Well, coffee. I don't know about you, but I've had a few cups today. Price of coffee, where's that established? The New York futures market. How does it get set? Well, it depends on supply of coffee coming out of Indonesia, Vietnam, Brazil. Demand for coffee is inelastic. We talked about that. Coffee prices fluctuate a lot, determined in the futures market. Cocoa, I don't drink cocoa. My daughter does. It's traded in the futures market. Orange juice, I've already told you that story. That's a very popular, soft commodity market. We have milk futures, dairy futures, cheese futures. If you had toast this morning, well, toast is made from flour that's made from wheat. Wheat's a large market in Chicago, and the price of wheat is going to fluctuate depending on global market conditions. What's the crop in Canada? What's the crop in Australia? What's the crop in the Ukraine? That's all going to be reflected in the Chicago market. Bacon, not good for you, but sure is tasty. Pork is traded on the Chicago Mercantile Exchange. The price of pork is determined in the futures market. Oatmeal, there's an oat futures contract. So that's our breakfast for this morning. So probably you've already been influenced by the price established in the futures markets. And the good news is that the price of a typical breakfast has gone down in the past year because commodity prices have gone down as established in the futures market. Okay? All these prices are down. And then we've got some other markets. I've talked about crude oil. There's a market called RBOB, which is gasoline before they blend ethanol into it. Then we have markets in heating oil. Heating oil's used for heating. It's close to jet fuel, so some of the airlines will use heating oil to hedge. I mentioned corn. If you go into a food store and you look down the aisle where they have manufactured food products, 80% of those products contain some corn. They contain some soybeans. Ethanol, now 10% of our motor fuel is made up of ethanol. Ethanol in this country comes from corn. In Brazil, it comes from sugar. And there's an ethanol futures market as well. So there's a futures market for all these items I've listed here. Beef, the guy in the video who was enjoying a steak was talking about the risks faced by the beef farmer. The input costs are influenced by the weather. The output price, the price of beef is affected by incomes. It's affected by the price of substitute goods. You know, if the price of chicken rises, that might affect the price of beef. Cotton. A lot of our clothing contains cotton. That's a large agricultural product that's traded on the futures market, not just in the United States, but also globally. We have a cotton futures market in China. We have one in India as well. Currencies, I mentioned. One of the TAs is spending more time in Europe than necessary because of the low euro, right? Currencies do impact us if we travel, if we buy products made in foreign countries. That price is influenced by currencies, right? If at graduation you go out and you buy yourself a new BMW or a new Porsche, that price will depend on the euro-dollar exchange rate. And then we have interest rates, okay? Does anybody recall what happened last week regarding interest rates? Was there any news about interest rates last week? Fed didn't change them. Who's the chairman of the Fed? Janet Yellen. Very good, thank you. So Janet left, not this Janet, the other Janet, left the interest rates unchanged. Now, were you surprised at that? Yes, sir.
I have a question actually. How can we trade like futures on interest rates if like that's just something that's controlled?
Okay, the question is, how can we trade futures on interest rates if that's something that's controlled? That's a very good question. And it's one reason why futures markets have had a struggle getting going in China, because the Chinese government still controls a lot of markets. Now, and sorry, what's your name? Chris. He was talking about something called the Fed fund rate. And that's interest rate that the Federal Reserve tries to set. But there's also market factors that affect the Fed fund rate. And that's very short-term interest rates. The interest rate banks charge one another for overnight lending. Okay? So you're right, to some extent that rate is controlled, but it's actually just a signal to the bank. So it's the Fed fund rate is largely controlled, but there's so many other interest rates. So that's just for the overnight lending. Then we have interest rates on treasury bills, say a 90-day treasury bill. Yes, the government sells those treasury bills, and yes, the supply of treasury bills can affect the price, but there's also a demand side. So where I'm going with this is interest rates, if we think of the spectrum from overnight rates to 30-year rates, are really established in the marketplace. Okay? So the price of bonds is established by supply and demand. So we have a bond futures price. We have a futures price on treasury notes, which are shorter term. We have a futures price on treasury bills. And those are all anticipating where those rates are going. And those are really market driven. Depends on supply and demand. There is a futures market on Fed fund rates, and that's the question I was going to ask you, Chris. But that's, in a way, more of a prediction market, to answer your question. So I asked you, were you surprised? And I wasn't sure what your answer was, but you know what? I wasn't, because I checked the futures market. So there's a futures market that predicts what the Feds are going to do. And they had a 40% probability on a change last week. Okay? And it turns out they didn't change. Now, she keeps saying we're going to raise it in 2015. That probability is now up to about 0.5. So that's questionable. So we're going to, pardon me?
They said by December, I believe.
Yeah, that's right. So we're going to go through explanation of that market, that Fed fund market. And there's probably going to be a question on the first midterm where we give you a quote from the Wall Street Journal. We're going to ask you what the market's predicting vis-a-vis the next change in the Fed fund rate. Okay. Did I answer your question about the interest rates? Yeah. Yes, sir. Yeah, so the question is, when I'm referring to commodity prices, I'm saying they're changing every few seconds, at least every day, and that's true. So that's for the raw commodities. So let's just think about coffee, for example. So, coffee's traded on the futures market. It's based on, green coffee that isn't even roasted. and that price fluctuates a lot. But when we go to the coffee house or the Starbucks, we don't see them changing the price very often. And you know what really drives me crazy is, and I've been known to do this, to go in there with a price chart showing them what's happened in the coffee market. When the price of coffee goes up, they raise the price. And they put a sign up that says, oh, we're very sorry, but you know, the world price of coffee has risen due to a drought in Brazil, and we have to raise the price. And then 6 months later, when it goes back down, they don't change it. So your question is a very good one, but it has more to do with, I guess, competition in the marketplace for final goods. And you know, if you look at a cup of coffee in Starbucks, what share is attributable to raw coffee? It's a fraction, 2%, 3%. Okay, thanks. I'll see you on Tuesday.